Welcome to the Damascus Network. I'm Kevin Cottrell. For this episode, let's focus on emerging markets. In the 1970s, the term less economically developed countries, or LEDC, was used to describe nations with social or business activity in the process of rapid growth and industrialization. Some world leaders felt this term had negative connotations. This led to the term emerging markets becoming the accepted vernacular. Currently, there are 28 emerging markets in the world. The advanced markets are Brazil, Mexico, Poland, South Africa, Taiwan, with the economies of China and India considered to be by far the two largest. The secondary markets are Chile, Colombia, Czech Republic, Egypt, Hong Kong, Indonesia, Hungary, Malaysia, Morocco, Pakistan, Peru, Philippines, Singapore, Saudi Arabia, Slovakia, Romania, Russia, Thailand, Turkey, and the United Arab Emirates. At Damascus Energy, we believe the axle of these markets is trade, capital flow, and commodities. We'll go into details after this message. The current state of emerging markets is ever expanding and is being led by three major factors: trade, capital, and commodity prices. The Damascus Network believes trade is the most important factor on the axle of emerging markets. Without trading partners, capital flow and commodities do not exist. The prevalent thought is that the largest amount of trade is between China and the U.S. or between India and Europe. But the biggest increase in trade patterns in recent years has been between emerging nations. Trade between China and the nations of the African continent are an example of trade opening the door for capital as well as commodities. Once a trading partnership has been established, then capital flow can commence. This leads to better infrastructure, capital for manufacturing and transportation, and movement of commodities. The second factor is capital flow. Labor is always a driving force behind a country growing its manufacturing base and improving lifestyles. Of course, the lower the cost of labor, the more appealing the area's labor force is to manufacturers. After World War II, the U.S., in its desire to find cheap labor and to rebuild Japan, sent goods, such as clothing and electronics, to Japan to be manufactured. Japan, looking for better return on investments, began investing in the Western economies of the U.S. and Europe. This triggered a technological spurt for U.S. companies. With this profound effect, U.S. companies wanted better returns than what stocks and bonds, savings accounts, or money markets could provide. Also, cheaper labor became the focus. With that, money was directed to emerging markets for better returns. The third factor in emerging market expansion is commodity prices. As a nation's economy improves, so too does the lifestyle and quality of life for its citizens. Past or older customers are no longer appealing to the younger generation who want bigger and better products. This causes an increase in the need for goods produced by developed nations. With that, the overall market expands, therefore increasing the costs and the cost to produce these goods. The markets of China and India are growing at a rate that is so rapid they are causing a global increase in the price of commodities such as iron, corn, oil, wheat, and cotton. In the process, the demands of China and the emerging markets have triggered a major redistribution of global income and wealth away from the commodity consuming developed world towards the economy-producing emerging world. In general, many emerging nations' economic prospects in China are becoming a lot more important than prospects in the U.S., representing an economic shift in the world's economic and political scene.
Damascus Network provides the vehicle for traveling the road to energy transformation. Our vehicle components are energy, globalization, and investment opportunities. Our expert analysis of these components ensures our vehicle is the most reliable in the industry. The axle that carries our vehicle consists of trade, capital, and commodities. We believe this axle is the undercarriage to your growth. Damascus Network, the road to energy transformation.
For this episode of the Damascus Network, our focus has been emerging markets. Here's an overview of our discussion. The 1970s saw the development of emerging markets. Nations with social or business activity in the process of rapid growth and industrialization. This currently consists of 28 nations, with China and India being the largest emerging nations. The Damascus axle of emerging markets is trade, capital flow, and commodities. Trade is the movement of goods between countries. Capital flow is the movement of funds to facilitate trade. Commodities are goods for which there is demand, but which are supplied without qualitative differentiation across a market. Commodities are often substances that come out of the earth and maintain roughly a universal price. Demand rates determine the universal price. And finally, globalization has encouraged the growth of emerging markets, with the elements of our axle being the primary drivers for this growth. These three factors, along with the need for cheaper labor, have triggered relationships amongst countries that have fostered trade, capital flow, and commodities. Today, this has resulted in the redistribution of wealth away from economically developed societies to emerging societies. For more information on today's topic, please visit our website, DamascusEnergy.com. For the Damascus Network, I'm Kevin Cottrell.